Good morning. It's Friday, May 17th, about 6 a.m. Central Time. Overnight, the precious metals are higher after yesterday Fed officials suggested that interest rates should stay higher for longer. While in the overnight session, we saw China continue to show a two-track recovery. Chinese retail sales grew at 2.3%, which is the slowest pace in 2 years, indicating that the consumer in China is really struggling, while at the same time, industrial production rose faster than expected. So I think that rising industrial production level was able to boost the copper market up 1% in the overnight session. We'll see if it carries over some momentum as that market has corrected the last 2 days. The CME did raise the margin requirements on it, so people are going to have to reposition, right position, and also meet some of those higher margin costs. Now, we did see the US dollar bounce. Remember, on Wednesday, massive sell-off in the dollar index, breaking below the 50-day moving average. But if you look at the dollar index on a longer time frame, you can see that it's been an upward move with those higher interest rates. So it's natural you get that sell-off. People are going to come in and purchase the dollar index back to the upside. Treasury yields also snap back, and the Dow Jones had crossed 40,000 for the first time. Now, what helped kind of temper some of the risk that was on in the previous days was we saw the meme stocks like AMC and GameStop; those all corrected. Same thing with Bitcoin. After a big $4,000 or $5,000 rally the day before, it took just a bit of a breather. It felt like more like a day that people were right-sizing, repositioning, trimming some excess positions out rather than being a hero in the market. So I do watch a lot of accounts trade through Blue Line Futures online, and I saw a lot of risk management being implemented. People were raising stops and trimming those excess positions. Now, what's interesting when you get to like gold and silver and other markets here, like platinum approached $1,100 an ounce yesterday. Now we're about $35 off that level. So people may believe that $1,100 an ounce is too expensive, given that just a couple months ago we were at $900 an ounce, and platinum, is going to fluctuate back and forth. With gold at $2,400, with silver at $30 an ounce, the gold-silver ratio had dropped from 92 to 1 earlier in the year, and beyond 92, that puts silver, it was down around $22 here. We saw a lot of people positioning for the long run. Now you get this move where we go from 92 to 1 to 80 to 1, and at this point, we're dropping just below that. People will start to believe that silver is too high. Now, I don't want to hear about the gold-silver ratio from different time frames, because I come from a time frame when it was about 40 to 60 was the general range we saw. And many of you that are older than me, I've been doing this 23 years, but people I talk to all the time have been trading silver since 70s, 80s, are telling me 20 to 1 is really the ratio that it should be at. So, the thing about the ratio is that it does trigger a lot of people's emotions, and people start to take different directional trades. They start to short silver. They start to establish more silver on that strength. And that is what's important, because that is what makes the bulls and the bears and makes these market efficient. So we are seeing a different type of trader come into the market right now. People establishing short positions around this $30 level. Now, pushing on into the S&P 500, I believe that critical support is just below that 5,300 mark. I'd call it about 5,295. I think if we do get a breakdown below that level, I think that people will come in and support that level as when the markets tend to continue to make new highs, people will buy those dips. It's just in their natural makeup of a trader. Now, crude oil prices continue to track sideways with about $80 on the upside for the July contract and $78 on the downside. We'll want to see a close over the $80 level in order to see continued momentum to the upside, and traders will come in and buy that breakout most likely with stop losses just below that $78 level. Now, a couple other things that I'm watching. I will be watching the precious metals all the way until the last tick at the end of the day. And the reason why I think you guys should check in with that as well is because a lot of times when we see markets close on a Friday at the high of the day, we tend to see people reading about it all weekend long. And then Sunday, they want to get involved with the market and they buy that market higher Sunday night. So we tend to see that Asian opening, the U.S. opening at 5 p.m. Central, and markets blast off. And then what ends up happening by Monday, we end up unchanged on the day. We saw that with the Iran-Israel when things really escalated. We saw that on the last few silver squeezes, and we saw that when the Russia-Ukraine conflict was really getting underway because people chase and they buy that Sunday night. I believe that Sunday is really a time for taking positions off because of the thin market conditions rather than establishing new ones. And I've done this a long time. So that is kind of my own personal risk management process there. So if we do close on the highs of the session on Friday, that Sunday night I will be in the captain's chair again, waiting for people to contact me to, if we do get an explosive move higher, take some of those positions off. So you got any questions, give me a call. I'll be on the Schwab Network at 2:40 p.m. with Oliver, and then also I will be writing an article on Kitco News and also posting to Zero Hedge. So if you got any questions, give me a call, 312-858-7303. Remember, futures option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.
Futures trading involves substantial risk of loss and may not be suitable for all investors.